You know that moment when you glance at a headline, raise an eyebrow, and go, wait, what? Well, I had one of those last week. India, a country that runs a trade deficit year after year, suddenly posted a $13.5 billion current account surplus in Q4 of FY25. A current account surplus for India. That is like a famous spendthrift friend suddenly turning into a savings guru. And it was not a rounding error, it was 1.3% of GDP, the kind of surplus we have not seen in years. So I did what I always do when something does not add up. I dug deeper. And what I found led me down a rabbit hole. A rabbit hole that uncovered a fascinating structural shift in India's economy and a potential gold mine for investors. Let's back up for a second. The current account is a simple concept. It tracks the money flowing in and out of the country through trade in goods and services, plus remittances and investment income. India usually runs a current account deficit. That is, we import more than we export. Oil is a big reason. Our energy needs are huge. So we always end up with a deficit. But this time something has changed, and I wanted to know what. First stop, imports. Sure enough, merchandise imports were down. Oil imports in particular fell, and that made sense because global crude oil prices had softened and demand was slightly lower. So we were importing less. Well, that helps, but not enough to flip the whole current account into surplus. There has to be something more. And that is when I looked at services exports. Boom. Services exports were off the charts, over $53 billion in Q4 alone, up nearly 25% year on year. That is huge. So naturally I thought, okay, must be the IT sector, that is India's crown jewel. Our software giants like TCS, Infosys, HCL and Wipro must be killing it. But then I checked their earnings and nope, flat to low single digit growth. TCS is up 3.5%, Infosys has barely moved, Wipro is stagnant and HCL has a very modest uptick. Nothing in their top line numbers could explain a 25% spike in services exports. Now I was really curious. If not IT, then what? So I went into RBI's balance of payment data and there it was. Buried in the services breakdown, a line called professional and management consulting services. This category was absolutely on fire. Double digit growth, way above trend, and it was carrying the weight of the entire services export boom. That is when I knew that we were on to something deeper. But what is this category really? Who is exporting all this consulting work out of India? Because last I checked, McKinsey and BCG were not suddenly outsourcing their entire operations to Bangalore. So where was this spike coming from? The answer, it turns out, is one of India's quiet success stories. Global Capability Centers or GCCs. These are the offshore hubs that multinational companies set up in India to run their back office. IT, finance, analytics, and increasingly strategic functions. Think of them as mini HQs doing real decision making work, just sitting in Indian cities instead of New York or London. India now hosts over 1700 of these GCCs, and they're not just doing data entry. They're doing everything from R&D to legal operations to financial modeling to ESG compliance, market analytics, and yes, management consulting as well. And here's the kicker. All the work that these GCCs do gets billed internally to their global parent companies. Those billings show up as services exports in RBI data. So when a US based pharma giant uses its Indian GCCs to run supply chain diagnostics, those fees count as consulting fees. And this counts as exports. This is happening across industries banking, tech, pharma, retail, insurance. The GCC model has gone from back office to brain trust. And that explains the spike in the professional and management consulting line item. And it explains why IT services revenue is flat while overall services exports are booming. The action has moved. It is not in the old outsourcing model anymore. It is in the high value, knowledge driven work being done in house by GCCs. And this has massive implications, not just for economists but for investors as well. Because even though the GCCs themselves are not listed companies, the ecosystem around them is. Who benefits when a multinational sets up a GCC in Hyderabad? You've got mid-sized IT and digital consulting firms developing internal tools, automating processes, and supporting advanced analytics. These firms often act as flexible partners to GCCs, complementing internal teams and accelerating execution. Then you have consulting and transformation service providers who help these global centers implement large-scale digital initiatives like AI integration, process automation, and cloud migration. Their value lies in augmenting strategy and execution, especially in high-skill functions. The staffing and skilling ecosystem is another big beneficiary. GCCs are hiring thousands of engineers, analysts, accountants, lawyers, and domain specialists. That demands filters through to companies offering tech staffing, workforce management, and corporate training services. These firms are playing a critical role in building the human capital that powers these GCCs. And then comes commercial real estate. Grade A office parks in Bangalore, Hyderabad, Pune, and Gurgaon are seeing high demand from GCC tenants. This drives leasing, infrastructure investments, and the broader commercial property ecosystem, including the REITs. Finally, you have digital infrastructure providers. Those building out enterprise grade telecom networks, managing cloud platforms, enabling secure connectivity, and offering cybersecurity solutions. Without this layer, the entire GCC model collapses. These players are the silent backbone of India's high end services exports engine. So, what we're looking at is not just a curious blip in the current account. We are looking at a structural shift, a new leg of India's export engine that is less about low cost coding and more about high value business thinking. And that is showing up in the macro data before it shows up in the earnings of the usual suspects. If you've been following this channel, you know that we have been skeptical about IT stocks recently. Flat revenues, shrinking margins, and cautious management commentary. But now we are starting to see where the growth is hiding. It is in this new breed of high end services delivered through the GCC model. And if you're thinking ahead about where India's economy is going, where the next wave of white collar jobs will come from, where urban infrastructure demand will explode, this is the space to watch. The industries that will benefit most are mid-tier IT and digital consulting services, staffing and skilling companies, commercial real estate developers and REITs focused on office parks, and digital infrastructure providers handling cloud, connectivity, and enterprise security. This is a long-term trend, the kind of quiet foundational shift that remakes an economy from within. It is not flashy and it won't make headlines like unicorn IPOs, but it is there, underneath the surface, moving billions of dollars and thousands of jobs. So the next time someone asks why India posted a current account surplus, you'll know it was not just about importing less oil. It was about exporting more intelligence. And that is a story worth tracking and investing in.